growth in wages over the December quarter were weaker than even the most pessimistic market forecast. Wages grew by 0.8% over the quarter. This was a clear deceleration from the September quarter and marginally lower than the June outcome. There were also other signs that the underlying momentum in wages growth is easing. The share of workers in the private sector reporting pay rises was lower than in the previous quarter and the same period last year. The average size of the pay increases was also lower than in the previous quarter. Importantly, growth in wages was lower than what the RBA or the Reserve Bank was expecting, and significantly so, by around 1/4 percentage point. We have previously flagged that there are downside risks to the Reserve Bank's forecast. The boom in overseas arrivals is increasing labour supply and reducing worker shortages. In Australia, around 2/3 of wages are set by enterprise agreements or awards. These take time to expire, renegotiate and update. The inertia this creates means wages growth in Australia is less responsive to conditions in the labour market. This is a key difference when compared to other OECD countries, which may help explain the relative underperformance in wages growth in Australia. In the US, for example, only 10% of wages are set by enterprise agreements. New Zealand has been recording a net outflow of working age people, which reduces the labour supply. So what does this mean for the Reserve Bank? The Reserve Bank is clearly concerned about the risk of a wage price spiral. They're concerned that higher inflation would lead to greater demands for pay increases. Employers are more willing to give these pay increases when the economy is overheating, which means they can pass on the higher costs to their customers. Indeed, just 2 weeks ago, the Reserve Bank revised up their growth forecast for inflation and wages. However, Wednesday's result suggests that there is very little evidence that this is occurring at this point. In our view, this is unlikely to change the interest rate outlook at this stage. The Reserve Bank will need to see more data confirming that the labour market has well and truly turned before they go on pause. But we expect the Reserve Bank to take notice of this outcome. Moderating wages growth, which are already lower than the rates recorded by our international peers, may mean that there is less upside risk to inflation. It may also mean that the Reserve Bank does not have to hike as much as other central banks. This will ultimately mean that the Reserve Bank may achieve that soft landing that we're all hoping for.